maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further, if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate.
Oh, wow.
Based on what each participant judges to be the most likely scenario going forward.
Whoa.
While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026.
Holy cow.
Still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Wow. Well, let's hear these questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So, specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell? Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this: we are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
The nature of that discussion today, thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was. And there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. And a preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Rachel? Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for. Thanks.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year. And it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it, so it's a possibility here. I have always felt since the beginning that there was a possibility because of the unusual situation that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're expecting, in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy. And I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor. And it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter. And as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over that assessment, really, over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward. But that's another assessment that we're going to make very carefully. So as time goes forward.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level with cuts beginning around March. Is this something that you are broadly comfortable with?
Good question.
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals. And that's what we really focus on. And people are going to have different forecasts about the economy. And those are going to show up in market conditions or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth. And, I'm just focused on what's the right thing for us to do. And my colleagues are focused on that, too.
Markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
So we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we look at the total as we make decisions about policy changes going forward. We're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Neil.
Hi, Chair Powell. Neil Irwin with Axios.
how do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, there's just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest that it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other, the unemployment rate is very, very low. And these are, but I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
We'll listen to one more question, then we're going to talk about this.
Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
I think we're going to call it there. Quite a lot of questions, quite a lot to cover. Goodness gracious. All right, so that was one heck of a meeting. Hi, I'm Jeb. You've probably been listening to this and wondering, who's that guy in the bottom left? That's me. If you're new to the channel, hi, my name's Jeb. And today we're going to talk a little bit about what Jerome Powell just said, because at the end of the day, I don't have a face. Let's try that again. At the end of the day, everything that Jerome Powell just said pretty much completely confirms what we've been anticipating, and that is that the season of rate hiking is more than likely over. He teased the idea that there might be another rate hike if we see certain economic conditions taking place, which are unlikely. That is essentially political speech for saying there's no more rate hikes unless, things turn around and something gets worse than it is. That forecast, that SEP, was very interesting because that forecast was essentially a poll of the different members of the FOMC. If you don't know, the FOMC is a member of 9 people. One of them is Jerome Powell. I believe one of them is always the Fed governor from the Federal Reserve Bank of New York, and the rest of them are on rotation from the other 11 Fed banks. And so that was a poll that he showed on screen there of what they expect to happen. So it doesn't seem like they're expecting to have just a off-the-cliff drop, but they're expecting to see the the Fed rate tail off over the course of several years, so that there's not a just huge stimulus into the economy, which would turn around right back into massive expansion of the economy, massive expansion of the labor market, which would then lead to large amounts of inflation over the course of 6 to 12 months, which would necessitate more policy firming, which would necessitate, in other words, more rate hikes. So if they drop the rate hikes too aggressively, then they just have to turn around and raise them again, and they don't want to, put that kind of instability into the market, because their entire mandate is the stability of the market. So that was very, very, very important data for all of us, and I do believe that that is going to be exceptionally bullish for the stock market. And being that we are a charting channel, we need to pay attention to that, because over the last 2 hours, we have seen a major rally on the S&P 500. If you haven't already noticed, S&P 500 is up 1.29% in an hour. That is a very large rally. S&P 500 breaking above 460 for the first time in over 2 years, breaking this high that was set just a couple of weeks after the Russians invaded Ukraine, pushing right back towards all-time high. As I said in today's morning live stream, S&P 500 will likely be back at all-time high by New Year's. At the same time, a rally is currently and actively taking place on Bitcoin in response to this news. As you can see, we put out a trade setup this morning. This trade setup did originally get stopped out, but then we came back up here to the same level and broke out. So that trade did end up getting stopped out at first, but then would have been another option here on Bitcoin once again, because when we saw this meeting come out, Bitcoin, as we expected, would rally to $43,000. That was the prediction this morning. We would see a rally to $43,000 on the back of the Fed news, and that is exactly what we saw happen. So markets are reacting to this exactly the way we thought they would. Stock market is going through a rally because, as the one fella said, I think he's from the New York Times, the one reporter said, many forecasters, many businesses, many companies are expecting that we're going to see a rate pause at some, not a rate pause, but a rate drop at some point in the next 3 to 6 months, and ending the next year by potentially as even potentially as low as 4.25 instead of 5.25. And so major changes coming to the United States stock market and the Bitcoin market on the back of this news. We essentially have confirmation at this point in time that we are going to see the Fed rate pause and stay paused, and we have essentially not a guarantee, but as close to a guarantee as you can get, that we are going to see rates dropping by at least 0.5 basis point next year, which will lead to stimulation in the United States economy, which will lead to growth, which will lead to jobs growth, which will inadvertently and undoubtedly lead to a rally on the stock market, which will lead to a rally on Bitcoin. Something we have to remember as analysts is that Bitcoin follows the United States stock market very closely. And so when the United States stock market is breaking all-time high, stands to reason that Bitcoin ought to be breaking all-time high as well. Well, the United States stock market is only a few points away from all-time high. As you can see, I want to say it's about 4% away right now. Sorry, 2% away right now. Bitcoin, on the other hand, is considerably farther away from all-time high. It is still a 55% rally to get back to all-time high. So both of those markets are likely to be in blue sky breakout coming Q1 of next year. And if we do see that occurring, what that means for us, the investor, is that we have a great responsibility right now to plant seeds that we will then be able to harvest in the coming quarters and in the coming years. In Proverbs, it talks about a man reaping as much as he can during the summer so that when winter comes, you're not having to be a pauper who begs on the streets. And as there is summer coming to the stock market and to the cryptocurrency market, there are massive investment and money-making opportunities before us right this very moment. The Fed's decisions, the effective federal funds rate being paused, and by the way, they didn't talk about it. They mainly talked about rates, but at the same time, looking at the quantitative tightening, which is continuing to occur, all of these factors are going to lead us to wanting to ensure that we are invested. And that's why I'm not going to show you on screen, but I'm just going to go over here off screen and casually make some investments right now so you know that I'm putting my money where my mouth is. You're going to see my face because I don't feel like getting hacked, but I'm going to go buy a few different assets right now. Just moved $1,000 over into Coinbase. We're going to go ahead and buy some this very moment. All right. Haven't done this in a long time. Haven't done an investment live on air, but let's do it. Dollar cost averaging every Friday, but I'm trying to aggressively build this portfolio right now. So I'm going to go ahead and pay with, need to convert that into USDC real quick. You guys are going to watch me do this. As far as you're not going to watch me do this, but I'm going to commentate it. We are going to take this tether that I just moved over here, transact it into USDC. I'm on Coinbase. We are going to sell the tether into USDC. Sell all of it into USDC. We're going to get 1,000 USDC. Boom, 0 fees because I have Coinbase One. Not even sponsored by Coinbase. If anybody from Coinbase is watching, you ought to do it because I am talking about your platform quite a bit. All right, got $1,000 in USDC. Let's add some more. First things first, we got to do it. We got to buy some Cardano. Gonna put $100 more into Cardano. Preview buy. Buying 153.47 ADA. Boom. Just bought $100 more worth of Cardano. I have more transactions coming in on Friday, but I wanted to add on top of the dollar cost averaging right now. Put $1,000 into it while we were live. Thought that would be fun. All right, let's see. What is the next thing we want to invest in? Tell me if this is interesting to you guys. We got Cardano's up 50%, Avalanche up at $40. Let's see. What's the next thing? Solana. Let's put some in Solana. I'm going to go put $100 into Solana. Solana. Buy $100. Solana. Pay with USDC. Preview buy 1.39 Solana. Boom. Order purchased. Good deal. Done. 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 Done one update. Did it finish? Let's see. We're buying Cardano live on air. We're buying Solana live on air. You guys are saying, buy this, buy that. Just bought 1.3914 Solana. All right. Moving right along here. We're going to get some Avalanche. Some AVAX. Gonna buy $100 of Avalanche. $100 of Avalanche coming in hot with USDC. Preview buy 2.40 214 AVAX. Purchase. View details. There we go. Good deal. Like I said, I've been aggressively building this portfolio over the last little bit. Cosmos. We're going to buy $100 of Cosmos. Actually, I'm going to buy $75 of Cosmos. That's what I'm going to do. I'm going to buy $75 worth of Cosmos. Preview buy, 6.39 Atom. Building that investment portfolio that I've been telling you guys you should be doing. I am putting my money where my mouth is, and I'm doing it aggressively. This is an additional purchase, by the way. Polygon. Got to do it. Let's put $75 into Polygon. $75 into Polygon with USDC. Preview buy. Buy now. 83.47 Polygon. Putting the numbers out there in case you don't believe me, because I'm not showing you. I'm not going to show you all of this. I'm just not doing it on air. But I can't make up these numbers on the spot. I ain't that quick, guys. Chainlink. We're going to buy $75 of Chainlink. $75. Pay with USDC. 4.98214 Chainlink. $75 coming in hot. Done. And I might buy one more altcoin over here that I haven't bought yet. So far in my portfolio, I have Cardano, Cosmos, and this is excluding Bitcoin and Ethereum. I'm dealing with altcoins right here. Cardano, Cosmos, Polygon, Chainlink, Avalanche, Solana, Polkadot, Near, Uniswap, Sheeb, Dogecoin, XRP, Stellar Lumens, and Graph. Very interested. $50 worth of DOT. Actually, I'm going to buy $50 worth of DOT. I'm going to buy $50 worth of DOT. Preview buy 6.7439 Polkadot. See how you guys are in chat. You guys are going crazy over here in chat. Jeb, you should make an example DCA portfolio where you buy $100 a week and see where you are in several years. That's kind of what I'm doing with this, except it's not an example portfolio. It's literally just my portfolio. So why buy after they pumped? Because I'm holding this for the bull market. And a lot of this stuff is going to be like 5 or 10 times higher than it is right now. That would be why. 6.7438 DOT purchased. All right. Moving right along here. I want some Uniswap. You guys know I love Uniswap. All right. $75 in Uniswap. Pay with USDC. Preview buy. Buy now. So while I'm doing all this, I'll just keep going in here and buying things. While I'm doing all of this, I'm going to tell you why. The effective federal funds rate pausing is a very important story for anybody who wants to get into cryptocurrency. And the reason for that is very simply, the Bitcoin market follows the stock market, and the stock market follows the Fed rate. The Fed rate is most heavily impacted by the Fed rate. The stock market is most impacted by the Fed rate. Sorry, I'm buying like 5 million SHIB here or whatever it is. $50 of SHIB. You guys are like, Jeb, what are you doing? You're buying SHIB. Yep, I am, because it is probably going to rally in the bull market. Why? Fundamentals. Do I have any interest at all in the fundamentals of SHIB? No. But I know how cryptocurrency people be like, to put it in the colloquial manner. Cryptocurrency people out here be like, that's how they say it on the streets, y'all. They be out here, y'all, hoping to get rich quick on Doge. So I'm going to buy it here, and I'm going to sell it at the top. Because here in 6 months, everybody's going to think Dogecoin is the way to get rich, and they're going to buy it. And guess what? I'm going to have already bought it, and I'm going to be selling it. Lumens. I'm going to put $50 into Lumens. That'll bring me up to $100 in Lumens. Building out a portfolio here, guys. Live, on air, 396 Lumens. Getting some Stellar. What else should I buy? What's your random little pumpamental coin that you're looking for me to buy? Now's your time. If you're enjoying today's stream, hit that like button, subscribe to the channel. Should we long Bitcoin? I gave you a Bitcoin long this morning, and it already played out. So you kind of got to wait for the next setup. This long has already occurred. Kind of missed the boat on this one. XLM and Doge, already got it. Everybody's saying bonk. E-Gold. XLM. Algorand. Yearn Finance. I think I'll buy a little bit of dust down here on some of these. Let's look at Yearn. I've thought about Yearn Finance. I think I'll buy $50 of Yearn Finance. Why not? Let's try it. I'm going to buy 0.00574 Yearn Finance. Let's do it. Done. Why not? Throwing money around. Let's see. What else? I think I want some more XRP. That's what I think. XRP's been on a dip, but it ain't going to last forever. I want $50 of XRP. We're on a buying spree right here, guys. It's the best kind of buying spree because we're not buying stuff and it's going to just be waste. The majority of this is going to make money. The only thing we're worried about is the opportunity cost, because pretty much everything we're buying here is almost certainly going to make something. I'm actually thinking I'm going to buy another. I'm going to buy another $50 of XRP. I got a good feeling about XRP. Oh, I've got a real good feeling. Yes, I do. Like it's lightning deep in my bones. Sorry for the lack of visuals. You just have to sit here and look at my ugly mug while we do this. I've got $66 left in here. Got like a few tens of thousands more that I want to invest, but for today, I've got $66 left in here I want to invest in. What should I put it in? What should I put it at? Jen sounds like he's at the online grocery store. I'm at the online grocery store going like this. Brrr, just straight into the cart. I'm going to need 3 carts, please. Fighting Film Productions said, look at the technicals on what? And you guys are going crazy in the chat. I love it. Jeb, buy some Beam. I'll send you the hundo if you lose money by next year. Cheers. Just lurking, sir. I think all right, you know what? I've never heard of Beam. Maybe I'll buy 20 bucks of it. Let's see. Beam. What is this? What is this? I can buy 1 Beam. I've no idea what this is. 20. You know what? Watch this. Just what? Can't even buy it. You can't buy it. It's not even on here. Okay. That's interesting. You can look it up. Did I say beam me up, Scotty? Scotty Beam. Yep, that's... I caught that reference. Not a Trekkie. I'm a Star Wars nerd, but Caught that reference. Won't let me buy it, so not an option. Sorry. I was going to buy one. It's 14 cents. I was going to buy one just for the meme. You guys are going nuts in chat. Oh my gosh. Flare, Ada, got Ada. H-bar, Gala. You know what? That's what I'm going to do. Where's Gala? How's Gala doing? I haven't looked at Gala in a little bit. Let's look at Gala. Ooh. I think I will get some Gala. Yes, sirree, I will. Tell me in chat, is Gala still doing stuff? Is Gala still doing stuff? I haven't looked at it much. Is Gala worth investing in? Is Gala worth investing in? I don't know. I'm going to do it anyway, though. Because I'm going to put like $40 in there. Got to do it. Oh, no. It's not supported on Coinbase. I need to go get that on Binance. Or somewhere else. Just kidding. All right. Gala's not an option today, guys. We're on Coinbase right now. Gala has issues. Stay away from Gala. Better. Let's see. Antov. Buy TIA. Mora said a lot of crap you bought. Stay away from Gala. The owners are suing each other. Oh, wow. Yeah, I'm not touching that then. Never mind. I'm good. I'm good. Thank you. Thank you, my loyal denizens of this internet space. Celestia. You guys want me to buy Celestia? Popularity number 41. Celestia is a modular data availability network built with the Cosmos SDK. Celestia's unique architecture offers developers a platform to build highly scalable decentralized applications and rollups. As Celestia directly provides the data availability and consensus layer, the Optimint provides the settlement layer. Developers only have to focus on building the execution layer. TIA is the native token of Celestia and can be used for gas fee payment, network governance, and staking participation. Interesting. It's the first modular blockchain network. Interesting. Making it easy for anyone to launch their own blockchain. Seems cool. Why not? Why not? We're dealing with play money here. This is money that we are okay with losing. It's not actually play money, but sure. Buy $20 of it. Sure. This is an experimental asset. Trading in experimental assets involves very high risk, including price swings. I understand. I understand. It's $20. That's why we're being careful and not putting a bunch into stuff that we're not familiar with. I'm not putting large investments in anything that I'm not familiar with. But sometimes it is nice to buy something almost as if it's like you're taking a note. Like, all right, I want to pay attention to this. Best way to get myself to pay attention to it is by buying it. And I'm like, oh, I own some of it. Maybe I ought to pay attention to it. Okay. Cool. Well, now what we're going to do is we're going to go over, as we always should, to the Earn program. And everything that we got, we are going... Yes. Good. Good. Good deal. All right, we're done for now. We're done for now. Just invested $1,000 live on air because we're excited about what... you regret... Hang on, I've heard a lot about this one. You'll regret not buying Sneck. What is this? What is this nonsense? Okay. Haven't looked into it. We'll see. All right. Become an H-Barbarian. Right. Okay. Well, that's it, guys. Hope you enjoyed the stream. Jay Powell spoke. We found out that we are going to see rate pauses coming in next year, and we're excited about that. I'm going to wrap it out. If you guys enjoyed today's stream, make sure to hit that like button and subscribe to the channel. We've got a lot to cover. More content coming tomorrow. You're not going to want to miss our video that we're going to be uploading tomorrow at 2 p.m. on Cardano. You guys are going to love, love, love that video. So like I said, I'm going to wrap it out. Before I go, though, I do just first want to thank each and every single last one of you for watching, as always, and I will see you guys in the next video. Peace.
Oh, I got a real good